China, officially the People's Republic of China, is the financial powerhouse of Asia. It is one of the most populous and powerful countries in the modern days, with a population of more than 1.4 billion. This nation has a unique but very successful financial system and makes huge influence in the world economy. The international financial market has improved since the various global crises, and the risks faced by many countries have been reduced. But still the growth rate of global economy has not been efficient. But there is a different story with the economy of China. During the economic recession, China managed to maintain economic stability through subsidies and lowering the leverage of its products. Subsidization affected lower commodity prices in the market, making Chinese products competitive in the international business platforms. Compared with the per capita income of European countries and United States, China's GDP per capita is low. Hence, China obtained cheaper labor cost and sold its product with better profit, which makes positive impact on Chinese economy. 40 years ago, China suffered a long-term economic stagnation and did not rank even among the 8 largest economies in the world. The impressive socio-economic transformation began in the late 1970s, hence, China is now on its way to surpass the United States to become the world's #1 economic power in the next few years. World doesn't know about the exact figure of Chinese government's success on economy and financial situations, since the Republic system of China doesn't simply disclose its internal matters to the world. We are living in what many people call the Chinese era today, as the Chinese economy is considered as second largest economy in the world after the United States. GDP growth before COVID crisis was estimated at 6.3%, but this figure would be even more if there was no US-China trade war. The International Monetary Fund forecasts China to continue growing at a rate of 6.3% continuously for few years. These forecast figures still put it well ahead of most other major economies' growth rates and keep it on track to eventually leave the United States behind, which has established as the world's largest economy since long. Manufacturing, services and agriculture are the largest sectors of the Chinese economy, employing the majority of the population and making the largest contributions to national GDP. The Communists entered Beijing and declared the nation as People's Republic of China on 1949. Since then, Communist government has been responsible for planning and managing the national economy. But it was only after 1978, when Deng Xiaoping began market-based reforms, that growth began to take off, averaging 10% annually for some 30 years. During that time frame, size of the Chinese economy grew by roughly 48 times, from about $168 billion in 1981 to $11 trillion until 2015. Since the introduction of Deng Xiaoping's economic reforms, China has what economists call a socialist market economy, in which a dominant state-owned enterprises sector exists in parallel with market capitalism and private ownership. It was the active encouragement of private enterprises from 1978 that enabled China to kickstart the long expansionary boom that continues until today. Private businesses now produce more than half of China's GDP and most of its exports. They also create most of the new jobs, which has been attracting foreigners recently. The attractive economy of China has implications and consequences with other countries on some levels, and it largely comes down to the opportunity aspect as well. According to the socialist market model, the Chinese government plays a direct role in managing the economy through a 5-year plan that sets strategies and goals. The 5-year plans of the 1980s and 1990s focused on market reforms, while the 2 most recent 5-year plans focused on promoting more balanced growth, better distribution of wealth, and better environmental protection. The current 5-year plan aims to improve China's competitiveness through more efficient and increasingly modern manufacturing on the East Coast, introducing labor-intensive industries into central provinces and increasing domestic demand. The economic growth that has been driven by product exports for the past few decades now relies more on domestic consumption. The ensuing surge in consumer spending provides an excellent opportunity for Australian companies to successfully market their products and services to an increasingly wealthy Chinese audience. But during the COVID crises, China has avoided some of the trading products of Australia, as Australian government supported the government of United States for researching on how China handled its starting phase of COVID crisis to stop spreading and the origin of the virus. Furthermore, China encourages foreign investment in key areas such as advanced manufacturing, energy conservation, environmental protection, and modern service industries. Stricter energy conservation and environmental protection regulations have also opened up opportunities for the foreign companies. Since the 1980s, the perception of China as a major low-cost manufacturing base has been changing with economic growth, and China has been effectively acting as a low-cost producer of global brands. Rising labor costs and an aging labor force have led to a steady decline in producer profits. Although cost rationalization is still an attractive feature of the Chinese market, global and local companies have only just begun to change their strategies to use China as a growth engine. The GDP data shows that Chinese economy has not been suffered by crisis as much as it was assumed. COVID-19 outbreak in a couple of provinces in China caused temporary fluctuation, but there won't be significant decline in the economy in comparison to the United States and European Union. China's economy has made a strong rebound, while the rest of the world struggles with millions of job losses and businesses shutting down. After a brutal lockdown, the Chinese economy contracted by a historic 6.8% in the first quarter of 2020, but it roared back to life as well. It shows that China's strategy of locking down cities hard and quickly has really worked in order to save the financial structure of country. Likewise, a combination of government-led investment and global demand for Chinese goods also helped to power a rapid recovery and boost exports. Regional Comprehensive Economic Partnership, RCEP, unites China, Japan, and South Korea in a trade deal for the first time, which also includes 10 Southeast Asian countries plus Australia and New Zealand. This trade deal has left the United States and India on the sidelines of one of the biggest trading blocs of the world. According to data from the Association of Southeast Asian Nations, the 2.2 billion people that make up RCEP account for nearly one-third of the world's population, and their share in the world economy and trade is roughly the same. The global economy could potentially grow by $186 billion annually with this deal. Although the financial system is not modern, an interesting paradox of China's success is its rapid growth. The Financial Repression Index, based on bank ownership, interest rate regulation, loan intervention, and cross-border capital flow control, shows that China is one of the most oppressed economies. It has a much lower degree of liberalization than advanced economies, but China's financial system was almost completely under control before the 1980s, and significant progress was not made in liberalization until around 2000, but it has stagnated since then. China has its own way of building national economy. How do you analyze the financial revolution and achievements of China? Leave your thoughts in the comments section below. Thank you for watching. Subscribe our channel World Facts to support us, and like this video as well. See you in another video. Cheers!